So we're going to look at September, yeah? So that was individual tax planning. So September 2015 must be question 3B. C. Kama ni September 2015 ni individual tax planning. So it's September 2015, question 3, question 3C. So read through this question, then we'll look at another one. So September 2015, we are looking at question 3C. This potential employee is called Violet. A woman has been offered a job with Apple Electronics Kenya Limited, a foreign company dealing with the distribution of smartphones and computers in the East African region. She's due to report on 1st January. Her terms of employment provide for the following emoluments. One, should get, yes? Or we did this one. Then we are not doing September. Tulifanya corporate tax planning. Ama we are to look at a second illustration. A second illustration. So the second illustration must be May 2019. So asema hii tulifanya. So May 2019, check May 2019. May 2019, there must be a guy there in question 4. If you can check May 2019. May 2019. Hiyo kweli. Get it. Mr. Albert Kimeli is November 2020. Sorry, November 2020, question 5B. It's called Mr. Albert Kimeli. November 2020. November 2020, question 5B. November 2020, question 5B. We did November 2020, question 5B. Now, did we start corporate? Because you do individual tax planning. Today as a corporate, to define corporate. We did even corporate. So what to do an illustration. Then it's September 2015 question 3B. So ile ingine ilikuwa C, sasa ingine ni B. September 2015 question 3B should illustrate corporate tax planning. September 2015. September 2015, question 3B says this. The promoters of June Fair Company Limited are considering the best source of financing for their new company. The promoters are aware of the two main financing options. So this is September 2015. Called June Fair. Junfair Company Limited. Junfair Company Limited. So the promoters of Junfair Company Limited are considering the best source of financing for their new company. The promoters are aware of the two main financing avenues for any company. So there is equity and there is debt financing. They already have raised equity capital amounting to 500 million as their base capital, which falls short of their capital requirements of 1 billion. So they need a total of 1 billion shillings. They have approached a consultant to give them advice on how to source the financing, how to source the additional 500 million shillings that they require. The consultant has assembled his analysis in two mutually exclusive financing sources based on the promoter's request as follows. So there's option A, the source of capital should come from equity only. So base capital was equity 500 million. So additional capital will come from equity also to get the target capital of 1 billion. Then there's also option B, the base capital which already they have is 500 million, but they can source additional capital from long-term debt to get the same 1 billion. It is assumed that both the additional equity and additional debt will require an annual payment of 40 million shillings and 50 million shillings for dividend and interest, respectively, every year. Assume that the profit before interest and taxes that the company will post each year is 110 million. The corporate tax rate is 30% required. Suggest from a tax planning perspective, the best source of additional financing that the consultant should recommend. So from tax planning point of view, yeah. So again, we have the two options to analyze. So analyze the two options. It will just be some brief analysis. Something very brief. So we have option A and option B. And this is shillings millions. So in the analysis, we are told to assume that the profit, the expected profit is going to be 110 million. So we'll say profit. Profit before interest and tax. Profit before interest and tax would be 110 million for both options. So profit before interest and tax would be 110 million. 110 million. Then you know that for option B, it has been proposed that they raise debt of 500 million and the cost of debt is the interest. So interest is a allowable expense, so less interest. So the interest on debt will be charged on the second option. It's supposed to be 50 million. So you see profit before tax. So profit before tax for the first option, equity only, is 110. The second option, it is now 60. When you lessen corporation tax, corporation tax will be at 30%. So 30% here will be 33 million. Here it will be 18 million. Now, profit after tax. So profit after tax is 77 million. Here it is 42, I suppose. Then you're going to lessen dividend. So option A are the equity, and we are told to assume they're going to pay dividend of 40 million. So whatever remains after that is what they've retained. Retained profits. So retained profit is 37, 42. But the decision is not based on retained profit. The decision is based on tax. What each option, how much amount of tax will be paid. So option B, you can see the tax is 18 million. That only. Option A, the tax is more, it's 33 million. And it's not difficult to see why the tax has reduced to 18 million in option B is because of this interest shield. Interest is a tax shield. The 50 million, 30% of 15 million of the 50 will give you the 15 million tax savings because of the tax shield. So we can therefore suggest or recommend, so say option E is recommended as it will result in tax savings. Or 15 million. So how did 15 million come about? Because of the tax shield on the interest. So the interest, if you multiply by 30%, you get the 15 million savings. The interest times 30% will give you the savings. So we recommend that they use that because from tax planning perspective, they'll save 15 million shillings. Okay, so that was our last topic of discussion. Okay, so with that now, maybe we can think in terms of block release or revision. So for the revision, we should be thinking topic-wise, even though you're free to make suggestions, but it's good to look at the topics. So the first topic would be partnership, because that was the first topic we looked at. So if I were to revise partnership, so topic number 1 was partnership businesses. Partnership businesses. So partnership has 3 areas. So the first area you ever look at in partnership is admission. A partnership admission of retirement. So when partners are admitted or retired, and Generally, you'll prepare a statement of adjusted partnership profit or loss, then admission of a partner in the course of the year. Where do you do the adjustment? In the distribution. You will split whatever allocations, whatever you're allocating to the partners, whether it's interest on capital or salaries or even interest on drawings, will be based on timing. Like if a partner, for example, is admitted at the beginning of 1st April, then the first three, you'll have everything split, the first 3 months and the next 9 months, the first 3 months and the next 9 months, so that you get the exact profit share for the first 3 months. You share in the own profit sharing ratio to the partners that were in existence. Before admission or retirement, the treatment is the same. Then the profit that accrued after, say, admission or retirement is shared in the new profit sharing ratio. So that's what happened. That's what happens. And then if you have any other incomes from other sources, we need something called specified sources of income. So specified sources of income means what is allocated in the distribution, for example, is the main activity of the business, but there could be other activities like rent. Then you share the same way, 3 months and 9 months. If there is something called dividend, especially from farmers' cooperative societies, at the grassroots to share in a similar way. So that is admission. Yeah. So the adjustment is made in the distribution. So you think about the distribution schedule adjustment. Distribution schedule. So that's where the adjustment is made. Then another area of partnership, apart from admission and retirement, is something called conversion. So conversion of a partnership, conversion to a limited liability company, LLC. So even the conversion will go according to timing. What period did the partnership run during the year? How many months? Assuming the partnership business was operated up to June. Okay, from July now you have a company. So for the period between January and June, you normally prepare a statement with columns. Column mbili, the first column in a core partnership, even though the examiner will tell you prepare separate statements, but don't bother preparing each different statement. You'll have a statement but with 2 columns. The first column is going to be partnership for the 6 months. The next column is going to be limited liability company. Then you allocate revenues and expenses based on the time. You do apportionment. The examiner will have given you a statement, will have said, assume that revenues and expenses accrued equally. So that statement should allow you to do the apportionment between the 2 periods. Then for the partnership, apart from the column of adjustment of profit, you must distribute, because the partners we said are not legal entities. So distribution means you share the income for each partner so that each partner is entirely responsible for their own tax liability. So you calculate tax on each partner as a person. For the company, once you've done the adjustment in the column, you can add even other sources. Kama kuna income zingine kama interest on fixed deposit account, you add there so that if the company has a profit, then it's taxable at 30%. That is conversion, would be according to time basis. Then the last part of partnership is called incomplete records. Incomplete records. So for incomplete records, it means you are not going to prepare a statement of adjustment. In other words, the examiner does not provide a statement of adjusted profit. What does it provide? Information. One of the key points the examiner will provide would be for balances. Atakupatia opening balances and closing balances of inventory, of debtors, of creditors, of accruals and prepayments, because you'll be looking for everything from scratch. For example, accounts receivable or debtors will help you to prepare a T account that will help you to get credit sales. Accounts payable or creditors will help you to get credit purchases. Then usually for cash items, you can get the information somewhere in the question, cash items, and that will help you prepare a statement from scratch. You prepare a statement from scratch, and then you prepare the distribution schedule. So basically, those are the areas of partnership. Do we have any questions before we look at one? Okay, so I'll look at a question in each of those areas, but not in any particular order, right? I'll pick any, because it's areas you have done, isn't it? So you can pick any order. So let me first look at conversion of an LLC. And for conversion, there's a question in April 2022. April 2022 had a conversion. So if you get April 2022, you're likely to find a question there of conversion of umepata ni question number 2B. Okay, I found mine finally. April 2022, you're right, is question 2B, yeah? Okay, April 2022, question 2B, but we can also answer A. So we answer part A first. It says, describe 6 factors to be considered when developing mitigation strategies for taxation risks. So factors to be considered, when developing mitigation strategies. Factors to be considered when developing mitigation strategies. Factors to be considered when developing mitigation strategies for taxation risks. Factors to be considered when developing mitigation strategies for taxation risks. The first factor is tax risk category. And you say this relates to whether it is compliance Those are categories. This relates to whether it is compliance, operational. This relates to whether it is compliance, operational, transactional, management, or reputational risk. This relates to whether it's compliance, operational, transactional, management, or operational risk. So those are tax risk categories. Next factor, likelihood of the risk occurring. The likelihood of the risk occurring, the likelihood of the risk occurring, the likelihood of the risk occurring. Next factor, potential impact of the risk if it occurs, potential impact of the risk if it occurs, potential impact of the risk if it occurs. Next factor, the urgency of addressing the risk, the urgency of addressing the risk, the urgency of addressing the risk, the urgency of addressing the risk. Next factor, estimated cost to mitigate. Estimated cost to mitigate the specific risk. Estimated cost to mitigate the specific risk. Estimated cost to mitigate the specific risk. Next factor, the resources available to the organization. Resources available to the organization. Resources available to the organization. Then the last factor, risk appetite of the organization. 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 Then we look at the next part. So the next part says, Amu and Weber have carried on business for the last several years under the trade name AB Partnership, they call themselves. They share profits and losses equally with capital contributed, earning interest at the rate of 10% per annum. Now, the following details relate to AB Partnership transactions for the year ended 31st December 2021. 1, Amu and Weber capital accounts reflect credit balances of 1,200,000 for each. Number 2, on 1st April 2021, they introduced a new partner, Chanda, who was to contribute 1,200,000. As his share of capital, they agreed on this day to share profits and losses in the ratio of capital contributed proportional to the period of the year it was invested, and that this sharing ratio be backdated to the start of the year 2021. The cost incurred during the year were as follows: salaries and wages for staff, electricity and telephone, repairs and maintenance, depreciation and impairments, general insurance, debenture interest paid by ABC Limited, directors' fees including 507, 720 partner salaries, legal expenses, medical contributions for partners and directors, drawings for Amoa Beba Chanda, rent and rates, motor vehicle running expenses, printing and stationery. 4, the following assets were purchased during the year: furniture and fittings, 192,000 pickup, 2,160,000. 5, during the month of the partnership, The total salaries to partners were 507,720. The salaries were to be apportioned according to the period each partner served in the partnership business. The cost of sales during the year was 21,600,000. Sales were uniform at a margin of 25%. The partnership was converted into a limited liability company, ABC, from July 2021, with the partners becoming the new directors of the company. The new firm was listed on the Securities Exchange, but not for purpose of raising additional capital. The cost incurred in listing was 100,000. The sales and expenses accrued evenly throughout the year, unless otherwise indicated. Required a schedule showing separately the profit or loss for the partnership and the company for the year, and tax payable refundable by ABC Limited, now the company, from the profit or loss computed in B Roman 1 above. 3, a schedule showing the distribution of profits among the partners. So this is a case of conversion, but not just conversion, it's also incomplete records. You see, you don't have a statement. So this is a typical case of incomplete records, and at the same time it is a conversion, so it will give us a bit of a review for both incomplete and say conversion. So first we'll prepare a format here. So this is B, they call themselves AB partnership. So B, so this is just business profit or loss, because it will combine both. So the first column will be AB partnership. AB partnership. The second column will be the company after it's converted. It's called ABC Limited. So we have to prepare the whole statement from sales. So the first thing we will look for is sales. So to be able to get sales, you have to use note number 6. Note 6 says the cost of sales during the year was 21,600,000. Sales were uniform at a margin of 25%. So if you're given margin and you're given cost of sales, then you have to look for markup and look for sales. So I want you to open a working note and try and get sales. Given note 6. So if you're using note 6, what would sale amount to? You've been given cost of sales and you've been given markup. So what is sales? Try and use that note to get sales. So note 1, we're trying to look for sales. So use note 6. So anyone, what's our sales? 28,800. 28,800. Kila mtu anapata 28,800. Everybody's getting 28,800. So we have cost of sales. Now cost of sales is 21,600,000. So that's the cost of sales. You've been given margin. What you need when you have cost is markup, not margin. So you have to know how to convert from margin of 25% to markup. So if margin is 25%, what is markup? Kama margin is 25%, markup ni ngapi? So you have to know something about converting from markup to margin. If markup as a fraction is 1 over n, margin is 1 over n plus 1. So what we have now is margin, 25%. 25 over 100 is a quarter. 25 over 100 is 1 over 4. So markup is a third, or 33.33%. Right? So I'll get a third of this, or 33.33%, I'll add. So a third of 21,600 is the markup. 7,200. So that gives you sales. 28,800. So the concept of markup and margin means, margin is from the side of sales. You're talking about the same thing. You're talking about this figure, 7,200, but from 2 points of view. So the examiner was giving you 7,200, but from the point of view of sales. So 25% of 28, a quarter of 28,800 gives you 7,200. But from the other side, markup, it is 33.33%. So if you take cost, you take a third. If you take sales, you take a quarter. Okay? It's the same thing. You're getting 7,200, but from 2 points of view. From sales, it is 1 quarter of 28,800. You get 7,200. From cost, it's a third of 21,600. You still get 7,200. So with that, we can start our statement. Because we were told revenues and expenses accrued evenly, so we must simply know the dates The partnership went up to which month? It's half-half. The examiner has made our life very, very easy. And Asema in 07, the partnership was converted on 1st July. So it's half-half. Half would be 14,400. Revenues and expenses accrued evenly. So 14,400 and 14,400. So that's our sales. Then you say less cost of goods sold, or simply cost of sales. So cost of sales, you 21,600. Again, you split half in happy 10,800. 10,800, that's for the partnership, and 10,800. So that gives you gross profit. So gross profit for the partnership in a backing up,
3,600.
3,600. 3,600. So that is still half of the 7,200, the markup. The markup, new gross profit. So 3,600, 3,600. Then when you reach gross profit, you look for any other trading incomes to add to the gross profit. Kama kuna discounts, kama kuna insurance compensation, kama kuna realized foreign exchange gains. Now this question did not have any other income, because if you look at note 3, all those are expenses. And note 4 are assets. So you don't really have incomes. You simply deduct allowable expenses. You say less allowable expenses. We deduct allowable expenses. Okay, the first expense there is called salaries and wages for staff, and you try to check whether there is any adjustment that might be required for salaries and wages for staff, and the reason, so you simply split it. So you say salaries and wages. So half of 1083 itakuwa ngapi?
541.5.
541.5 is a deduction, and 541.5 is a deduction. That's salaries and wages for staff. Electricity and telephone, you check whether there is any adjustment on electricity and telephone, and there isn't, so you just get half. So electricity and telephone. So half of 389.4 ni ngapi?
194.7.
194.7. 194.7. Repairs and maintenance, again, there is no adjustment for repairs and maintenance. So repairs and maintenance.
157.2.
157.2. 157.2. Repairs and maintenance. Depreciation and impairment is not allowable. You know, it's a loss of a capital nature, so it's not allowable. We bring in general insurance. So general insurance, half of that would be 235.5. Then we have debenture interest. The examiner is very kind. He doesn't want to confuse you, and he tells you it was paid by ABC Limited. Normally, he would not tell you that. Even if he doesn't tell you, you must know that a partnership cannot issue debentures. Debentures are issued by a company incorporated and probably listed at the stock exchange. So debenture interest, you don't split, you charge the whole amount to the company. The examiner is very kind here. He even tells you it's a cost of the company. So the debenture interest is 150.36. We charge the whole of it here. Then directors' fees, including 507.72 for partner salaries. So actually it's half. So the part for partner salaries, you know, it's not allowable, but directors' fees will charge the whole of it to the company. So directors' fees. So the one for partners is half of it, the 507.72 you will not charge, but for directors we will charge the company because it's allowed 507.72. Directors' fees. Then we have legal expenses, which you can split. Legal expenses. So legal expenses, half of 510 to 14 in Gapi. 255. 255.12. So that's legal expenses. Medical contributions for partners and directors. Medical contributions for, we'll just get half, but medical contributions. Medical contributions. So half of that is how much? 325.92. Medical. 325.92. Drawings are not allowable. Those are drawings by partners. Then we bring in rent and rates. Half of rent and rates are going up in 140. 157.98. 157.98. That's rent and rates. Motor vehicle running expenses. Motor vehicle expenses, half would be how much?
250.38.
250.38. That's motor vehicle expenses. Then you have printing and stationery.
$16.26.
16.26. So the following were purchased during the year. We have furniture and fittings. We claim investment allowances for furniture and fittings. But before that, we have this little cost in note 7. The partnership was converted into a limited liability company in July, with the partners becoming the new directors of the company. The new firm was listed on the Securities Exchange, but not for purposes of raising additional capital. The costs incurred in listing are allowed. So listing expenses. So listing expenses, the cost of listing is 100. We'll charge that on the company because it's the company that was listed, not the partnership. So we are not going to split that, listing expenses. So that should be it, apart from investment allowances. So we should now bring in investment allowances. So bring in investment allowances. So the assets that are included here are in note 4, the following assets were purchased. They are furniture and fittings. Furniture and fittings is 192. We get 10%. 10% of that would be 19.2, and half itakuwa ngapi? 9.6. Then the other cost is pickup. Pickup is 2160. Then you get 25%. Then you can get half. Half is 270. So 270. 270. So with that, because they don't have any other income, I can close both. Otherwise, for the company, we could have added any other income they would have obtained. Kama kuna other sources, but this question did not have other sources of income, so everything will just end there. Otherwise, you'd have added on the company. Kama kuna other sources of income. So partnership ni ngapi? Partnership ni 1195. Like that. 0.84. 1195.84.
Taxation is 437.76.
437.76. So because there was no other income, everything ends there, and we call this, I'll just call it business profit. Business profit or loss. Then for Roman 2, tax payable by the company, ABC Limited. So for ABC Limited, you see corporation tax. ABC Limited, it's going to be 437,760. You simply multiply by 30%. You get tax of how much?
131.
131.
328.
388.
328.
328. $131,328. That's the corporation tax payable. Then finally, Roman 3, a schedule showing the distribution of profits among the partners. So distribute 1195.84 distributed to the partners. So prepare distribution schedule. So Roman 3. So Chandler joins in April. So the other partners are there for 3 months, January, February, March. Then he joins in April, May, June, when it's converted into a limited company. So everything will be split in 3 months. So starting with salaries. So we'll have salaries for the first 3 months. Total salaries for the whole partnership period is 507,720. So for 3 months, you just get half. Because the partnership only ran until June. So it's just 6 months. So half of 507.72 ni ngapi?
253.86.
So half is 253.86. So that is half. And there's something about Note 5 says the salaries were to be apportioned according to the period each partner served in the partnership. So just apportion equally. Yeah, even the profit share at the beginning of the question, B at the beginning, they share profits and losses equally. Okay. So what is half of 253.86?
126.93.
This is 126.93. 126.93. Like that. Then salaries for another 3 months after the other guy joins is 253.86. Now you get a third of that. They share equally.
Excuse me.
Yes.
Part of the member who joined in April, are we billing Salary for the other ones.
No, he didn't get. You can see there's a dash. We only paid A and B. So 253.86 apart ngapi?
84.62.
So this is 84.62. So that was our payment of salaries. Then what else were the partners paid? I think interest on capital. Interest on capital is at the rate of 10%. Capital contributed at the 10% per annum. So we have interest on capital. Again for 3 months. So each one of them actually contributed 1.2 million each. So interest on capital, for example, for 10% is per year. Okay, the partnership ran for only 6 months. So tutafanya apportionment. Amua contributed, for example, interest of, capital of 1,200,000. 10% will be 120, but 120 is for the whole year. Okay, so we want only for 3 months first. So 120 times 3 over 12 would be 30. And this would be 30 also. So it's 120 times 3 months over 12 is a quarter. So a quarter will be 30. And 30. And nothing for a friend. So the new partner. So that's 60. Then another 3 months. Would still be 30 for the remaining 3 months. 30. And this one now gets 30. The total is 90. They did not get any other payment from the partnership. So hii utasema share of profit. Again, 3 months. In 3 months. And this we have to look for. Share of profit, we just leave space like that. Then you bring in 1195.84 we had earlier. And then we open a working note to look for these amounts. So this should be note 2. We are going to say share of profit. So you have 3 months. And 3 months. And use the total column to get these amounts. So we are going to use the total column to obtain these amounts. For example, salaries. Using the total column, total salaries for the first 3 months was 253.86. Total salaries for the next 3 months was still 253. Then interest on capital. The first 6 months was 60, and this one was 90. Then share of profit. So you'll get half of 1195.84 for only 6 months.
597.
This is 597.92.
0.92.
Then you subtract 253.86, then minus 60. The difference in happy.
284.06.
284.06. That is what will be shared here. 284.06. So the other half is 597.92. You subtract 253.86 and 90.
254.06.
254.06 will be shared here. 254.06. So the first 284.06 you divide by half. We share between A and B. So half of 284.06 ni ngapi?
142.03.
This is 142.03 and 142.03 and nothing for C. The new 254.06 you get a third in the pattern.
84.687.
84.6.
Kindly adjust the camera.
84.6.
687.
687. 84.687. So 84.687, and this is 84.687, and this is 84.687. Then you get the subtotal. Get the subtotals for each. That's for A. A is 498.267. 267. And then B.
498.267.
267, the same, eh? $199.307. I hope if you add these three, you get 1195.84.
Yes.
Very good. So far we've shared income from trading. So we look for any other incomes. So the only other incomes that would be here, which we need to include, would be when they became directors, they earned some directors' fees. So we can add to their incomes here. So they became directors in the next 6 months, so they earned directors' fees. So again, 3 months for directors' fees, and directors' fees is 507.72. So half of that itakuwa ngapi? Half of 507.72.
253.86.
Then half. Each one gets half of that.
126.92.
126.92.
93.
93 and 126.93, and C doesn't get. Then the other half of director's fees, half of 507.72, then you get a third.
84.60.
84.60.
60.
84.62, 84.62, and 84.62. Then you get the total taxable income for each. To 11. So now kila kitu hapa haiwezi kuwa to 11 peke yake. Your partnership was 490 plus this plus this, huh? 709. 817. The same year, so you 709.817. Alafu ya C ni ngapi? 283.967. 92.
Yes.
So that's it. So it has many things. It has conversion. It has a bit of incomplete records. Actually, it was a case of incomplete records and conversion at the same time. And admission. That's how you treat admission of a partner and even retirement. So any question? Then we can look at September. You may not finish, but if you don't finish, you will also try and do what you can with it. September 2021 is a question 4. By the way, I'd sent answers to theory questions. Did you see them? Yeah, I'd sent answers to theory questions, so you don't need to answer part A. You can get. You want to unpack here, then 2021. Did it have 2021? Anyway, you check. So we can look at September 2021, question 4. We look at the B part. September 2021. Check WhatsApp, Terry, they're there. There was 4 there. If you're in the same group, you should be able to see them. In the class WhatsApp. So September 2021. This is September 2021. Question 4B. Question 4B is called JM Traders. So the solution to the theory questions were together with a handout on alternative dispute resolution ADR. Please read alternative dispute resolution and professional ethics. They are short handouts. Will take you a very short time. So this says Jirani and Wema have been partners trading as JM Traders since January 2019. They have not filed individual income tax returns for the year ended 31st December 2020. The Commissioner for Domestic Taxes has issued an estimated assessment of $948,000 to each of the partners for the year ended 31st December 2020. They share profits and losses in the ratio of 2:3 to Jirani and Wema respectively. They are preparing to appeal against the assessment and have approached you for tax advice with the following details. So cash book summary, so you have balance brought forward, capital for Jirani and Wema, receipts from debtors, cash sales, rent income, sale of furniture, payment to creditors, purchase of furniture, motor vehicle expenses, electricity expenses, rent expenses, purchase of motor vehicles, salaries and wages, office partitions, general expenses, balance carried forward. No additional information, sales and purchases for the year were understated and overstated respectively by 10%. Two, all the cash sales were paid into the bank with the exception of 528,000, which was debited in the income statement as general expenses, but related to the following items: partners' children's school fees, purchase of goods, tax appeal expenses, insurance policy for partners' life, computer software. The partners are entitled to interest on capital at the rate of 10% per annum on their capital contributions. The interest on capital was included in the figure for purchases for the year. The cost of furniture sold was 192,000. And had accumulated depreciation of 16,800 as of January 2020. The profit on disposal was credited to the income statement for the year ended 31st December 2020. Other information provided was as follows. Opening balances and closing for inventories, creditors for goods, debtors for goods, electricity expenses prepaid, rent owing, rent and rates, sorry, salaries and wages owing, furniture. The business reported a net loss of 509,400 for the year ended 31st December after deducting the following expenses: salaries and wages for the year ended 31st December, which included partner salaries for Jirani 120 and for Mwema 96, rent and rates. So the rent expenses for the year included 20% for private residence for Jirani, while electricity included 30% electricity bills paid on behalf of Mwema's private house. Capital allowances in respect of the business had not been considered. However, depreciation had been debited in the income statement. The depreciation was at the rate of 20%. With supporting computations, advised the partners on the accuracy of the estimated assessment issued for the year and prepare a schedule for total taxable income for the year. So this is just partnership. So you've been given this net loss, you're supposed to adjust, but it is also involved in complete records. Some of the items can be picked, others you have to determine, and so on. So the first thing I want you to do, why don't you look for credit sales and credit purchases from the information given? The opening and closing balances are given in note 5. Opening and closing balances for creditors for goods and debtors for goods. So first, look for credit purchases and credit sales. Because we want to start our adjustment from the trading account. So the trading account will mean we'll start with note 1. We have to adjust for sales and purchases which were understated and overstated. So to adjust that, you have to know the amount of sales. So look for sales. So what did you get as your sales? So how much is sales? Pata ngapi? So we are looking for credit sales. And we have opened a T account for debtors. We are also looking for credit purchases. And we open a T account for creditor. Use those accounts. So the balances are given in note 5. For creditors, opening balance at the beginning of the year is 480. So we have balance brought down 408. For debtors, balance brought down is 288. Debtors, balance brought down is 288. Then in the cash book summary, there are receipts from debtors, and it is 2040 receipts from debtors. So debit, cash book, credit here, cash book for receipts. The amount is 2040. Received from debtors. And on the payment side, payments to creditors from the cash book is 1056. So cash book for payments is 1056. Then I'll just put the closing balances. So closing balance for creditors is 336. Balance carried down is 336, and I balance off this T account. The balancing figure here is our credit purchases. You're saying it is?
912.
912. So this total is how much?
1361.
1361. 1392. Okay, the closing balance for debtors is 432. So balance, cut it down, is 432. So balance of this T account. $21, 94.
94.
That's credit sales, so we'll use this figure. And this figure of 912. So, note 1 says sales was understated. So if you understate sales, then profit is understated. So first you want to add back understated sales. Understated sales, and sales were understated by 20%. So credit sales is 2194. Then you look at the debit of the cash book. There are cash sales of how much? 1.2. Cash sales of 1.2. Then you again look at note number 2. All the cash sales were paid into the bank with the exception of 528. So there's another 528 which was not paid into the bank. So you add another 528. Now that will give you the total sales. Now these total sales were understated by 20%. So this is only 80%. So you multiply by 20 over 80 to get the understated amount, which we add back. 9. So 978 will add back here. So 978. Still on the trading account, they are saying purchases was overstated. So overstated purchases. So the credit purchases from our computation is 912. 912 is our purchases. Then you look at note 2. There's an additional purchase of goods of how much? 240. That was purchased from the sales they made. They used the sales to purchase goods. So you add another 240. That's still purchases. Then we adjust for note 3. Note 3 says the partners are entitled to interest on capital at the rate of 10% per annum on their capital contributions. The interest on capital was included in the figure for purchases. So look at capital on the debit of the cash book. Jirani is 720, Mwema is 1080. If you add their total capital is 1800. 10% is 180, so minus 180. 10% of capital. Now that is purchases. Now this purchases is overstated by 20%, so it's 120. So multiply by 20 over 120 to get the overstated purchases. And that's how much? $162. So if we are through with the first adjustments which were in the trading account, then go down to note number 6. Note 6 says, note 6 is the P&L adjustments. Note 6 says the business reported a net loss after deducting the following expenses: salaries and wages for the year, which included partner salaries, so add back partner salaries. So it included partner salaries for Jirani, so add back 120, and then for Mwema, we add back 96. Then rent expense for the year include 20% for private residence of Jirani. Let's first deal with rent. Rent expense relating to Jirani. So rent expense relating to Jirani. First of all, the rent paid according to the cash book, look at the credit of the cash book is 472.8. So the rent paid is 472.8. Then you come to note number 5, is rent owing. Rent owing at the beginning of the year is 93.6. So that's an accrual at the beginning of the year, 93.6 you subtract. Then you add accrued at the end of the year is 52.8. Alafu ya Jirani ilikuwa 30%. Walisema ni 20% ndio ya Jirani. So unachukua 20%. Hiyo ndio tuna add back. 20% of the rent expense.
86.4.
86? 86.4. So that is rent. Still on that note, there's electricity included 30% bills paid on behalf of Mwema. So electricity expense. Ama niseme tu electricity, kuna ile ya Mwema. So electricity ya Mwema, again you go to the cash book summary, electricity expenses paid is 93.6. That is what was paid. Then you look at note 5, there's electricity expenses prepaid, prepayments. Prepayment at the beginning of the year you will add 566, prepaid at the beginning of the year. Then you deduct prepaid by the end of the year is 36. Then 30% is what was paid for Mwema.
187.2.
So 187.2, that's electricity. Then still on note 6, capital allowances in respect of the business had not been considered. In other words, they had not considered investment allowances. Okay. However, depreciation had already been debited. So we need to add back depreciation, which had already been debited. So depreciation on all assets would be debited. So they're saying depreciation was at the rate of 20%. So let's start with furniture. So furniture, the closing balance for furniture is 240. Depreciation is based on the closing balance. So furniture balance is 240. Depreciation was 20% of 240. And 20% of 240 is how much? 48. The other asset that must have been depreciated was motor vehicles. So motor vehicle is newly acquired. You get it in the cash book summary on the credit. It is 720. So again, you get 20% of 720 must be 144. That's motor vehicle purchase. Then there are office partitions. Office partitions need 216, and you get 20% of 216, which is how much?
43.2.
20?
43.2.
43.2. So we've already adjusted for depreciation. To adjust here. Then what else? Look at note 2. All cash sales were paid into the bank with the exception of 528, which was debited in the income statement as general expenses, but related to the following items. Partners' children's school fees is of course not allowed. It was debited as general expenses. So partners' children. So school fees is added back. So add back fees of 96. Purchase of goods is allowable. You add back tax appeal expenses. Tax appeal expenses is 48. You add back insurance policy for partner. So partners, life insurance. You add back partners life insurance of 84. You also add back computer software. Computer software is 60. And that completes our add backs. So using your add backs. Then what is our deduction? Our first deduction would be note number 4. The cost of furniture sold was 192 and had accumulated depreciation of 16,800 as of January. The profit on disposal was credited to the income statement. You must deduct it because it's a capital item. So you must deduct profit on disposal of furniture. But we do not have that profit, so we have to look for it. That would be note 3 probably. So we look for profit on disposal of furniture. So let's look for profit on disposal of furniture. We'll put here working note 3. Disposal of furniture. So we'll open a T account, the disposal account. So the first thing from the furniture account, we bring the costs of furniture that is being disposed. The cost of furniture sold is 192. So you credit the furniture account and you debit here. So from the furniture account, you debit the cost of furniture being sold, and the cost of furniture being sold is 192. So 192. Then in note 3, they tell you, no, note 4, accumulated depreciation is 16.8. So you credit accumulated depreciation, 16.8. Then you look at the debits of the cash book. You're going to see the disposal value of the furniture. Sale of furniture, they got how much? 204. So you use the cash book, you get the disposal value of 204. Then you balance all this T account. You should be able to get the profit on disposal. So this is 220.8. So what is the profit on disposal? 28.8. So that is what you deduct here. 28.8. You deduct from the income statement. Because it's a gain that is of a capital nature. So deduct 28.8. So what else will we deduct? Investment allowances. So let's deduct investment allowances on all assets. Starting with furniture. So for tax purposes, you don't just pick the closing balance. You look at its investment allowance is calculated on a reducing balance basis. So you look at the opening balance of furniture, and the opening balance is 192. Then you add the furniture that was purchased, you get it on the credit side of the cash book summary. 240 was purchased. 240, yeah? Then you subtract the disposal. Use the disposal value in the cash book, 204. You subtract 204. That balance remaining, you get 10%. $22.8. Then for motor vehicles, you don't have a problem. They were acquired this year, so there is nothing like reducing balance. You just check the balance in there. Cash book summary for purchase of motor vehicles is 720. Then the rate of allowance is 25%, which gives us how much? 180. So 180. Then for office partitions is 216. Office partitions. They were acquired this year. 216, you get 10%, is 21.6. Then you have this computer software, 16, so computer software. Is 60, you get 25%, which is 15. So you can be able to get the adjusted profit or loss. Then you will prepare the distribution because of time. Utatengeza distribution baadaye. Distribution schedule. So let's get the total add-backs and the total deductions. Then we can stop there. You can prepare the distribution baadaye at your own time. This is 268. 0.2, those are deductions. Add-backs ni ngapi? 21.8. All right. So what is the adjusted profit? So profit ni ngapi? Yeah, 1375.2, and we stop there. So unaweza prepare the distribution schedule for that question. So every partnership must have a distribution. So Roman 2 requires a distribution schedule.